Welcome to the Real Estate Women's Podcast. Thanks for pulling up a chair to our roundtable discussion. Here, we'll teach you how you can create a stream of passive income through multifamily investing, and we'll help you to shift your mindset so you can start living the life you really want to be living by design today.
Hello, everyone. We're the Real Estate Women, and I'm Tamara.
I'm Crystal.
I'm Candy.
And I'm Colleen. Welcome to the Passive Investing Podcast. In today's episode, we are going to discuss how to fund large purchases of multifamily properties, the different types of loans and debts used, and how the GP team qualifies for such loans. That's why we brought Julie Ann Peterson on for this episode today. Hello, Julie.
Good day, everybody. How are you?
Hi, Julie. Great. Good to have you on.
Thank you.
We're so happy to have you. All your info and background is just perfect for this. Julie here, she has 30 years of real estate transaction experience, and she does not just source funds. She actually consults with her clients to solve, their immediate needs. She works with all type of income-producing real estate at all levels of the capital stack. Julie's clients are typically real estate entrepreneurs who depend upon many different relationships they establish, as well as the relationship with the capital provider, and that is no different for her. So that's super important. So welcome, Julie. It is so great to have you here today. To get right into things. A question that is, typically on all passive investors' minds is, where exactly are all of the funds coming from to purchase these large multifamily properties? In this industry, we call it the capital stack. But could you kind of just shed some light on what the capital stack kind of is for our passive invested listeners?
Absolutely. Well, first of all, thank you so much for inviting me to chat and visit with you and your passive investors here. Listen, the capital stack is going to have a bunch of levels of different investors, whether it's the capital markets, whether it's retail, whether it's your pref equity partners. So when we talk about going to a lender, that's going to be your biggest partner. Okay, that's going to be your capital markets. That's going to bring maybe an agency loan, whether it's a bank loan or a debt funds loan. Okay, so that's your biggest partner. Those are the guys that are bringing the most amount of money. The second could be a pref equity partner. They're going to bring maybe the gap funding, right? Maybe they're going to give you all of your capital in the stack after the lender. Or then there's retail. And that's where passive investors bring in their money. That's the stack that many of the passive investors maybe who are listening, that's where their money is in the stack. So from where I stand, we are a mortgage banker, mortgage broker, and we provide the lending on it, which would be your biggest provider of the debt, of the capital stack.
That's the first time I've ever heard the investor pool being referred to as retail.
Same.
Yeah.
Right. So
because
I'm kind of like thinking about that. I never thought about it that way. But when you think about it, it makes sense for that label to be like the retail aspect of it.
Because they're going to be paying. You're going to be paying. Well, they come last. Unfortunately, they come last. You have to pay me first to pay back my mortgage, right? Then you have to pay your pref equity, right? They're going to want their monthly. And then they get maybe paid 8% in every month, and then there's an accrual. So they're also going to get paid when your investors get paid, which is it gets them whole. And then the retail investors, they usually get, in this market it's a little bit different, but it could be that they've got a preferred return. And that preferred return is anywhere from 6 to 10%. Some cases it's 12. But that does not get paid until obviously you get some cash flow.
And not all of the properties have a pref equity partner. You could just have a lender.
They could have just a pref equity. Yeah,
And
that would be a big investor, right?
yeah,
And in that case, you could say, I'm going to pay you every month, let's say 12%. Okay. They may not have any upside to the deal as well. Yeah, just a big investor could come in as that. Yeah.
Okay. Oh, gotcha. Okay, so that's one of the different ways. So if, and let's say a GP or a team sponsoring a deal decided to have that pref equity partner, that large partner, they would go above essentially the typical investors. Okay, I know
That's
personally
right.
I haven't seen deals like that, but that's a good way. It's good to know that some people do operate that way. I know. I think for most of us here, we're usually typically the deals that we deal with. I think typically go. You have your bank, and then you have. We typically call it private equity. I think maybe you ladies. I'm not exactly sure, but that private equity would be those that come in, the passive investors who receive that preferred return. So that is the first time I've ever kind of heard that being referred a preferred return being that additional large lender. So that's good to know. It's an option.
So they can be considered a lender or they can be considered an investor. It just depends on how they're written into the contract. So let's talk about when you're looking at private equity, like you're talking about private investors, um, they're going to be paid maybe quarterly, maybe monthly, right? As
Mhm.
well as a preferred equity partner. But let's say in this market, especially, it's you can't capital raise all of it. And so you call up your buddy and you say, hey, I need $2 million. And that guy says, I can help you, but it's going to cost a little bit more money, right? So the concern is that your investors, you've told them we're going to bring in all of these investors and we're all going to get paid a certain amount, and you bring that other equity partner, their shares will be diluted, or they
Uh,
could be diluted. So you got to be really careful. You want to know who and how much you're capital raising up front, because when it gets diluted, your investors just don't like that.
yeah, that's definitely a really good nugget for anyone out there looking to be a passive investor. That's an important question to ask. Make sure you're asking that GP
Yeah.
team, where are the funds coming from? And it's little nuances like this that is really the reason we wanted to have you on here, because there's so much for even for us to learn, that different people operate in different ways. So there's definitely a lot to learn. And I guess one of the kind of questions that we have for you as like the lender, I know there's a lot of different types of debts and loans that can be put on it. This world we're living in right now, we're seeing a lot of things kind of go wrong, and there's a lot of things like bridge debts and all that different types of debts that can be going wrong, or when anyone had their interest rate not locked. So can you tell us a little bit about the different types of debts and loans that can be placed on commercial property?
Sure. And if we talk about commercial, there's all different asset classes within the commercial. So I'm
Yeah.
going to really talk about multifamily.
Yes.
Um, I'm a loan officer with Old Capital. We're a mortgage broker. We will do all their asset classes, but we really are premier providers in the multifamily. So if you talk about the best type of loan options is going to be your agency debt. This is a product that came out about 10 years ago. It's a government agency loan. So it's Fannie and Freddie. Now, they also play in the residential, but for our conversation today, we're talking about 30-year amortized loans. So you get a little bit less of a payment based, in comparison to, let's say, going with a bank loan, but you're looking at 5, 7, 10, 12, 15, 20, and 30-year loans. Okay. So you've got a lot of options with agency. This is a non recourse loan. That means you kind of are the babysitter. Okay. As an investor, as a general partner, let's call it that, the people that are signing on the loans, they're signing with the idea that they're going to manage as a babysitter. But if they fail or default, it's going back to the bank, it's going back to agency, it's going back to Fannie and Freddie. Okay. Which is different than what happens on a bank. That's recourse lending. Okay. So agency, everybody wants agency because of the longer term, 30-year AM, all of the options when it comes to the term of the loan. We also do interest only. There's the possibility of getting 1 year or up to a full term IO, interest only. So you think about this. You've
That's
got all
amazing.
of these rents coming in, and you're only putting out the interest payment, which is amazing. And
Yeah.
that allows you to use that capital to do distributions, but also it allows you to use that capital to do renovations. Now, you can capital raise the renovations, or you can use it organically from those cash flows. Okay. So that's agency. There's different prepayment penalties. It's based on the 10-year treasury. So today the 10-year treasury is around 3.8. It's been fluctuating a lot lately just because of the environment that we're in. When we look at how we put these loans together, there's the index, which is your 10-year treasury plus a spread. And the spread over the last 5 years has been pretty steady. But over the last year, it has been fluctuating. Okay. So if I take the 10-year treasury, as I mentioned, it's around 380 today, add a spread, which is about 225, that's going to be your rate. Okay. And when we work with agencies, these on the Fannie side, they will fluctuate until you get the commitment from the lender. That's about 5 days before you close. On the Freddie side, when you sign on the loan, it is locked. So, things to be thinking about when you're looking at deals as a passive investor. What kind of lending are we going to be putting on this? And if you're using agency, are we locking the loan day one and we know exactly what it's going to look like? Or are we riding the wave? And if we're riding the wave, then are we going to need to bring in extra capital? Okay. If that seller, because it's all based on agency loans, are all based on cash flow, these got to be cash flowing assets. So if the seller takes their foot off the gas, then I can't give you as many proceeds. So again, as a passive investor, you're going to want to say, is there the possibility that I need to bring in more cash, which could potentially lessen my shares? It would dilute your shares a little bit before we close. So it's always some really good information to kind of be thinking about. Okay, the very best we're going for, why you're going for it. It is really a protection for the general partner, because you don't want an asset, if it defaults, that the general partner is personally liable. Now, we certainly do syndications where you would use a bank, and the bank would be this recourse lending. But some investors say, I don't want to put our general partners at risk, and I understand that. But if there's new investors that are taking are becoming a syndicator, that may be their only option. Why? Because the agency needs an asset that needs 90% occupied. Okay. If an asset is not 90% occupied, then they have to look at other options. And the bank is an option, or a bridge loan. And we saw a bunch of bridge loans happening over the last couple of years. And I'm sure you've heard of it. It's out in the news. From a syndication perspective, if you're looking at trying to do some renovations and you don't have 90% occupied, maybe you're doing a motel, right? And the motel has some long term, maybe some people that have signed, I don't know, there's people that stay in hotels long term, they have a lease. If there's some leases in place and you're going to want to do some renovations, we would use a bank or we would use a bridge loan. And that gives the general partner some time, like 3 years, to make some renovations. Okay. And you're moving people around, moving them to different units, and getting them moved in until it's stabilized. Stabilized, at that point, you're either going to sell it or you're going to refinance into, hopefully, this agency loan, which is, longer term debt, better product, and really offers the investor the ability to get some real stabilized distributions. Does that make sense, ladies? I did a lot of
It does.
talking there.
Yes.
It
A lot
does.
and one of the things that's, this is lending is something that people don't think about when they're looking at an investment, the type of lending that is on an asset. And it's, they just think, oh, they have a loan. And there's so many variables that go with it. And like you said, the person that's providing that type of lending is the biggest partner in the whole deal.
Yeah.
And like you said, that's the person that gets, or the company that gets paid first. So it is the most important to pay attention to, because what is the structure of that? And then how will that affect the shares of the investor? One thing that, so let's say it is a property, which often seems to be value add, or it's a distressed property. So they don't have the occupancy that you need. So you're kind of forced, you don't have that choice. You're kind of forced to go into either a bank loan or into the bridge debt that seemed to be a very popular event the past year and a half. So let's say you're doing that, but now you're going to do hopefully a refinance. How can you be, as an investor, how can you look at the projections of what the team is projecting that interest rate is going to be on the refi? Like, how can you be like, we know it's a guessing game, but how do you say that's good or that's not so good of a guess?
Yeah, what's the
Well,
safe?
I would tell you, in this market, it is challenging. It's challenging because we were working within a very condensed, a compressed cap rate environment. Okay. And we were able to look at things and say, okay, I'm going to hold this for 5 years, and my reversion cap rate is going to be 10 basis points every year. So I'm going to just add another 50 basis points, and boom, we're there. We can see it, what the value is. We just are having a hard time figuring out what the values are. It's the game has fairly changed over the last year. And so to really be able to say, okay, I'm looking at this PPM and I'm recognizing that in year 3, we're going to go take this renovated property and get into an agency loan. I have to make some assumptions. I have to make some assumptions, and the general partner needs to make some assumptions about where the cap rate is. And that's simply by having conversations with the local property management, also talking to brokers. Where do we think this is going to be? So that's one thing. Secondly, your NOI, the net operating income, which is your income minus your expenses, gets you your NOI. This is how we value these assets. So if we are looking at, okay, where do we need to be in year 3 in order to qualify for an agency loan? We have to make sure that we've got the targets. We've got to make sure that the income is coming in. And what the challenge has been is that the rents have started to go down, occupancies have gone down. So this is a huge, huge challenge. So what we're doing is we're getting with a lot of our clients who have done business, and also not our clients, but people who have actually got into these bridge loans, and we're sitting down and we're looking at their NOI and saying, how much time do you have left on that bridge loan? And if your NOI is 500 now, and in order to get to 70 or 75% on an agency loan, we need to get the calendar out and start saying over the next 12 months, this is where your NOI has to go. And if not, here's the sad story. There will be the potential of selling it and taking a loss, or selling it and having to put another bridge loan. We call it a bridge to bridge loan. Or, are we going to be able to hold on to the occupancy at at this bridge loan maturity date, and keeping all those numbers in line, we may have to have a cash in, not a cash out refi, but a cash in refi. What does that mean? That means a capital call. We don't want to see them, but there are operators that are doing the best job that they possibly can in this environment, ladies. And it's not because they're doing anything other than getting hit with this rent decrease and occupancy. They've stabilized their expenses, but because of taxes and insurance, things are really getting challenging. And 60% of the loans today were done with bridge loans over the last couple of years. And those are coming to maturity. And about 40% of those will have capital calls, we speculate. So what does that mean to your investors? Okay, that's really the bottom line. How does that get interpreted to our investors? So again, as we talked about the capital stack, okay, I need to bring in capital. What does that do when you bring in capital? It dilutes the investors' shares. So in some of the PPMs, the way that they're written, you have to offer, or you need to insist to your investors, hey, I need you to bring in this money. If you want to keep your shares, I need 10,000. I need 50,000 from each one of the investors. Now it's up to the investor to say, okay, here's my credit card. Okay, here's some more money. But the question remains, are we going to be able to stabilize this if we get to the point where we need to put money in because we're not cash flowing? But if we get to the point where they put money in early and then we need more money, at what point do the investors say, I'm not putting any more money into this sinking submarine? No, I'm not. So that's the risk we're seeing. And that's where these pref equity people are coming into the stack, diluting those shares. And, if you're in a deal right now, I would be having that conversation. I'd be having the conversation with the general partner and say, is there a concern of a capital call, right? Where are we at? Are we protected? A lot of them may not be able to identify that yet, but being understanding, you may need to bring some capital in.
And now, are we seeing that in deals that are not using bridge debt? Like, that's really only being seen in deals that have bridge debt, because the agency loans, we're not worrying about that, right? Is it really the bridge debt where there's the risk, or is there another type of debt that can be that little red flag for investors right now to just keep that extra lookout on?
It's really the biggest influence here is on the bridge debt. But here I'll tell you this. If there are maturities on agency that you're at 3.75 and I want to keep this asset, okay, you're at 10-year maturity, your option is to go in at the higher interest rate. So if you haven't created enough NOI, I would think after 10 years you're pretty good. But if you want to refi, let's say you're on a 5-year loan, you may have to bring some extra capital in. It is what it is. The other thing that people are not taking into consideration is an assumption. We're seeing a lot of assumptions where people, started to get in right around COVID. They got a really good rate. They want to exit that strategy. And, oh, wow, this is great. I can get in at, 4%. Awesome. But you're getting in, let's say, with only 2 years left. Okay. So, and you're underwriting it at 4%. That is a mistake. You need to be underwriting it as a general partner and as an investor, recognizing that when you go out to reinvest or to refinance this, if it's, right around the corner, it needs to be at what the current rate is or what we're seeing today. If we look at the forward curve And I love the forward curve because it kind of shows where the speculation is in the months and years to come. The forward curve shows on the 10-year treasury. The 10-year treasury is what is dictates on these agency loans. Remember, I told you 10-year treasury or 7-year treasury or 5-year plus the spread. That 10-year treasury is showing a dip and it's going up. So if you're going to be looking over the next 2 years, there's going to be a dip. But when we're taking out these loans that you're going to hold for 5 and 10 years, it's showing it's going up. Okay. So we need to be taking that into consideration for the refinance. Does that make sense?
It
Yeah.
does.
It does. Yeah.
Good.
It's really interesting. I'm so glad that we had you on because this is one thing that I even when I talk amongst my team, they get like a generalized term sheet. I just do quotes because it's just a piece of paper that just says, oh, this is what it is. Like you were saying, this is what the index is. This is a spread, and this is what it is. Well, that's great, but it's like saying to the looking at loan interest like this and the type of packages out there. It's like saying to a builder, I want to replace the windows in my house. How much will it cost? But they never come and look to see what kind of windows, how old they are, what the condition, whether it's a brick building, wood frame, none of that. And then I'm seeing a lot of people just like saying, oh, this is the better rate. We're going to use this because that's what they said they got.
Yeah.
It's every house is different. So every construction project to replace windows in a house, there's always going to be different nuances. And that's something that I don't see people really addressing and talking about. They're doing a one size fits all with lending, and that is not the case. And only until when you get to closing, when you get that rate, it's like, how come we didn't underwrite it at this? How is this going to work? What are we going to do?
Yeah, Candace, that is a great. I really appreciate you bringing that up because, from the lending standpoint, there are a lot of people that do my job, right? And we're all trying to get more business. A lot of brokers, a lot of lenders, they want to spend the least amount of time with you. Okay. And the least amount of time with you is saying, here is what the rate is. They have not underwritten it. They have not looked at your financials specifically for that asset. Remember, in multifamily, we are using financials. It doesn't matter what the color of the door is. It doesn't matter what street. It doesn't matter what street it's on, but not like you're going to be doing in single family, right? So it's all about you're buying a business. Okay. And you've got occupancy, you've got vacancy, you've got economic vacancy, you've got, the current debt on it. There's a lot of factors that go into putting these deals together. So a lot of these lenders they'll look at a sheet, their quote sheet, and they'll say, okay, in this market, it's 75% max LTV. Okay. So they give that to you. And they're going to say 30-year AM, and they're going to say, okay, you want 7-year financing, and the prepayment penalty, I'm going to give you the cheapest debt. Okay, they have not underwritten this. They don't know what the financials look like. So you're going along, you're communicating this with your passive investors with this assumption that I'm getting 75% because that's what the quote sheet said. Okay. It's wrong. And what, you work with a broker or a lender that's going to take the steps to underwrite this for you, tell you where the challenges are, tell you that, it's not 75, it's actually 60. So now you can go and say, I need to capital raise 40%.
Yeah.
Okay. And now you're communicating with your investors that say, okay, your shares, your 50,000 is worth a certain amount of shares. Okay. Instead of at the last minute, now again, we're bringing in somebody else that's going to dilute it. That's a bad relationship with a lender. And we just don't like to do that. We don't want to put out garbage. So when a general partner is looking to find out what the terms are, we can give you high level. That'll get you in the game. It'll get you into the underwriting and modeling. But if you're really looking to put in a letter of intent, your LOI, that's going to then take you into a contract. You're really going to want to go to your lender and say, okay, I am ready. We have checked in with our insurance. We've checked in with our property manager. We've checked in with taxes, payroll. All of that is already configured. All I need is to know what the best product is and what it looks like based on our financials. Now that's a snapshot. When you give me the financials, it's a snapshot on a Thursday, right? It's your April financials. Well, we have May, we have June financials. I'm looking at April. Things have changed over the last 2 months. And going forward, these take 60 days and sometimes more to close these loans. So if my financials are based on April, I've got 4 months where it could change. So as an operator and a buyer or a borrower, we need to be having the conversation with that seller and say, hey, buddy, I'm in contract with you. You need to keep the NOI up. You need to keep these doors filled. And if it drops, I'm going to take a change in pricing maybe. Maybe that's what gets put into the PSA, all right? Because if, let's say, it drops below that 90% occupied for 90 days, you've got hard money into this and it blows up. Now we can no longer give you financing on it. So it's really important to have this relationship with a bank or a broker and get you underwriting and get you as long as we call it garbage in, garbage out. If you're giving me February financials, that's a shot in the dark. Things have changed overnight. To get the best financials over to the lender, the most accurate rent rolls, and then we can really provide you with accurate information. Garbage in, garbage out gets you bad feedback from a lender. I'm sure that makes a lot of sense.
No, that was very helpful because, in the long run, that's all really good, important information. And as the passive investor who's, learning all of this right now, like, some of the terms like the LTVs, like they might not be familiar. That's like the loan to value, like the loan that you want to receive versus the value of your property. But what it really comes down to is the questions that you need to be asking to the sponsor before you put your hard-earned money into this. You need to say, how did you get these numbers? Did you speak to the bank? Have you done this? Have you checked all the boxes that Julie just listed? Because if they can't answer those questions, that means they did not do their due diligence correctly. And like Julie said, garbage in, garbage out. So if you as a passive investor don't know what questions to ask, you could just be stuck in a pile of garbage. And that's not what you want. So that was very, very helpful, Julie. Thank you.
Sure.
Yeah, that was great. It's something that I don't know. There's so many pieces. People, I've noticed more and more when I'm particularly talking to investors. Everyone is very familiar with single family, and they can understand even if they rent an apartment, they understand that their expenses to be paid. And then when you have single family, well, it's a little bit different because you're in charge of the maintenance if you own the home. So when I talk to my investors about multifamily investing, I talk to them that it's all of what you have learned and you know about, but it's all mostly under one roof. But there are other nuances that, because it is a large number, that you have to take these other nuances into play that are extremely important. And one of them is the debt. To understand, you don't have to know as much as Julie knows. I mean, all you need to know is to have the contacts with the people that do know. And then you can ask the right questions and they can guide you on what might be a better decision to be making. So, I mean, that's one of the main reasons we wanted to have you on the show, because you're an expert in this, Julie. And I know that you've definitely steered me in different directions to,
Yeah.
sometimes, kick team members in the butt to pay attention before we just like randomly pop in an interest rate into the underwriting.
Yeah, definitely. And I think the other question is from an investor standpoint, and I'm confident you guys have covered this in the past, is to invest in a group, a team that has a track record, right? I'm not, as a lender, I'm an investor as well. I'm a general partner. I run into this a lot where an investor says, I'll put it with anybody. But you really need to do your due diligence. And in that, they're also like, ask the question, what is the relationship? Who are you putting your lending with? Are you jumping around to all these different lenders, or are you
Right.
partnering with a lender or a mortgage broker that has a track record? Because they're going to be able to get this deal done and through and closed. There's a lot of people that have money that need to, whether it's a 1031 exchange, or they're not making any money in the banks, that's for sure, right? And they want to deploy this capital. And if they're sitting around for 4 or 5 months waiting for you to close this deal because the lender that they're working with, the general partner is working with, is putting their cash, sit in an idle position, that's not good. So before you place that capital, ask these questions. You want to move and get your money deployed quickly and moving it. And that's going to require a general partner to be able to close this and have those relationships with the right partners.
Well, this has been very helpful because I think I don't want to assume or fill in blanks for people, but however, I think people think it's about the asset more than, and not seeing a lender as a partner. And they see it's the property, or have you done this before? And it's like all about the property and like what goes into the qualifying of a commercial. Just even starting there or staying there between residential and commercial is so different that this really sheds a lot of light on that the lender is part of the team, that it's,
Yeah,
and I don't know that
absolutely.
that's mentioned as much as it should be.
Well, it is. And I would tell you that when you're working with a broker, it's like we open up our trench coat and we've got all of these different kinds of
Like the watch person on New
ways.
York Street.
Yeah. Yeah. It's like I'm a carpet seller, right?
Got your
But
carpet samples.
exactly. But the thing is if you're going directly and the general partner doesn't have a relationship with this bank, and
Right.
they're putting themselves and the deal at risk,
Right.
and you just don't want. There are lenders out there that are in it for themselves. They don't know, and you don't know that going in by yourself. So yes, I would agree. The lender is your biggest partner, and to have a relationship, seeing as a investor in coming into the deal, how do they play into this? How do they help? Because for me, I bring to deals, I will bring investors to the transaction. I will bring my team to the transaction. So this relationship is critical to the success of a deal. There are some lenders that are behaving badly, and if you don't have somebody who works on your behalf, you could be by yourself. So
Even the bits and pieces I'm seeing, like you said, people are getting really excited because the interest rates are killing deals right now. And I'm seeing more and more opportunities coming that, it's almost like they have flashing lights. If they could put them on there, it's like assumable loan. But you don't, the case in point, and one of the things that you pointed out is that I don't see in that flashing light assumable loan for how long
Yeah.
Right.
that's assumable for. You don't see that unless you ask. You don't know to ask unless you know to ask. And there's this. I'm noticing too. that there is like this pressure, almost like buy now, it's going to sell out, buy now. And it is a rush to get to the finish line for the team members because of all of the little bits and pieces we need to do in order to close on the property. But as an investor, if you're just feeling pushed and rushed, then honestly, I say walk away.
Yeah.
Just walk away,
Yeah,
and
good
the
point.
right investment will come.
Yep.
And and even if the deal is great, but something about you personality wise, you're not connecting with the general partners. Even if the deal looks like a sweet deal, walk away, because that relationship, you're not going to have that relationship when, let's say you have a question. Are you going to be able to call that person or contact them? Are you going to get that response that you really need as an investor? I mean, all of these things are really important, whether in your world it's called retail, in our world we call it the private investor. It's all really, it is, even though we all have different roles. One's more active and the other one is more passive, even though it is technically not 100% passive, because you do have to do your due diligence. We're still a team, and we still need to be able to work together cohesively.
Yeah, I would, yes, I would say exactly what you said. I think that, over the last year, it's been difficult to kind of figure out where we're going. Should I stay in multifamily? Should I go into different asset classes? It really doesn't. I mean, yes, it matters what you invest in, but when you're looking at a general partner and trying to figure out, is this the right fit for me? Also consider, and if this is just not from a financial statement, from being a lender here, but since we're limited and general partners, all of us, what I like to think about is, okay, I like to see financials on a monthly basis. And I used to be an operator on my own assets. Now I do it as a team in multifamily. But I looked at my records every day. I looked at who was moving in, who was moving out. I like to look at it on a daily basis. Now I put my money in with a quarterly, and it drove me nuts. So that's another question that you need to be asking the general partner. How often will I know about this asset? How often will I be communicated to? Because if it's not enough, you're going to be in that asset for quite some time, 5, 7, 10 years. So know it up front, because that is going to be, you're going to want to be satisfied with that decision that you make. Don't make it thinking, okay, I'll be okay with that, if you haven't really checked in with yourself. I did it, and I'm sad that I made that choice on a couple deals.
Great advice. Well, I think we're getting close to running out of time, but we got a couple things. One, if our listeners want to get in touch with you, Julie, how do they do that?
Oh, I love that. So I am on all socials, right? So LinkedIn, Facebook, Instagram, Julie Ann Peterson, Julie Anne Peterson. Okay. Also, I would invite all of your listeners to come in and take a look at Zoom at 8. It's a place where you can find deals, you can find investments, places you can invest in. You can build relationships there, and you can come join us every Tuesday night at 8 p.m. Eastern. And the way to do that is you sign up on dancinginvestments.com. Dancinginvestments, that's plural.com. So I hope that, that would be helpful to your investors to come join us.
And I just want to add, I love Zoom at 8. And for investors listening, it's not intimidating. It's just like this. We're talking, we're sharing ideas. Listen to me, I'm talking like I'm part of Zoom at 8 in this.
Well, you are.
I love it so much because it is non-intimidating, and you can ask any question. And there's so many professionals that Julie brings to the table on every part of the team, that you can get their information and then be able to connect with them outside to really dig deep into what it is you're looking for as an investment. I can't say more about it because and it's a lot of fun because Julie has a great sense of humor. And anything else you wanted to add to that, Julie, before we or
No, I
anybody
think
else?
that that's great. I would just say it's a cautionary time. Know who you're investing in. It's going to probably take another year, but you want to be deploying capital. You want to move your money. Letting it sit there, it's rotting. It's just like an egg, a carton of eggs rotting. So move it, get it into somebody that you and a team that you know, like, and trust, who have a track record, and make sure that the lender is on board. So I appreciate that.
Great. So we have one last thing that we do is kind of fun. We do like a mind thought provoking quote of the day, and we have 3 cards that Tamara has. You get to choose one from 3.
Okay, so am I going from the left or the right? No, just kidding.
1, 2,
I'll
3.
take the middle. I'll take 2.
Middle. Okay, the middle one is don't look for the needle in the haystack, just buy the haystack, by Jack Bogle.
So what am I supposed to do on this now?
You use some kind of profound words of wisdom, just like you do at the end of your lemonade.
Okay,
What does that make you think of? What does that? How does that make you? What does that provoke?
Just buy the haystack.
Yeah.
Hey, listen.
Don't look for the needle, just buy the haystack.
Yeah, I think you run the risk of losing money. You have to do your due diligence. So I do like the fact of that you have capital to afford that. Does it make sense to maybe put a little bit into that haystack so you can buy a bunch of other haystacks? Just depends. Are you looking for a JV deal? Are you looking for a syndication? So I think the overall arching for me is you need to do your due diligence before you do buy any of that, and then to determine how much you want to put into it. What's your position going to be in that buying that haystack?
Yeah, I think for me, I think about it says, what is my risk tolerance? If I'm going to buy the whole haystack, there's going to be a little bit more risk. The higher the return, the greater the risk. Yep. So sometimes different opportunity that may not be showing the same returns as another one, but when you look at all the pieces that we just discussed, might be the better bet.
Well, and then are you going to buy it with credit? And then if I could provide that, let me do that.
That's awesome.
Well, thank you, Julie. We want to thank you for being here today. It was a lot of great information, on funding the deals, and I'm sure the listeners picked up tons of knowledge. And it was just awesome. Thank you for being here. So we want to thank our listeners for joining us today at the Roundtable. If you want to learn more, you can check us out on Instagram, Facebook, YouTube, and visit our website at therealestatewomen.com.
Thank you, Julie.
The information contained in this podcast is for educational purposes only. We are not licensed professionals and do not give investment advice, tax advice, or other professional advice. Please consult a licensed professional before making any financial decisions.